you're losing $4,200 a year to inflation. The Fed's inflation fight is on, with significant implications for consumers and investors. What does this mean for your wallet? The current economic landscape is complex, and understanding the effects of inflation is crucial for making informed decisions about your finances. As the Fed continues to raise interest rates to combat inflation, it's essential to consider how these changes will impact your daily life, from the cost of groceries to the value of your investments. The current inflation rate is 4.5%, which acts as a hidden tax on your savings and purchasing power. For example, if you have $10,000 in savings, the purchasing power of that money decreases by $450 over the course of a year. And with the average American household income being $67,000, that's a significant hit. But it's not just savings. Inflation also affects the value of your investments. A 4.5% inflation rate can reduce the value of a $100,000 investment by $4,500 over the course of a year. So, what can you do to protect your finances? One strategy is to invest in assets that historically perform well during periods of high inflation, such as real estate or commodities. For instance, the price of gold has increased by 15% over the past year, outpacing the rate of inflation. But some argue that investing in these assets can be risky and may not always keep pace with inflation. And with the Fed funds rate at 3.62%, borrowing costs are increasing, making it more expensive to take out loans or credit. This, in turn, can lead to a decrease in consumer spending, which can have a ripple effect on the economy. So, it's essential to stay informed and adapt your financial strategy accordingly. Next, we'll explore how inflation affects your daily expenses. But the part that surprised me most is what this does to your grocery bill. Imagine having to pay an extra $100 per month for the same groceries you're buying now. That's what's happening to many Americans, and it's not just groceries. The impact of inflation on daily expenses is far-reaching, and we'll dive into the specifics next, including how to reduce the burden of inflation on your household budget. For example, a family of four that spends $1,000 per month on groceries could see their bill increase by $45, which may not seem like a lot, but adds up over time. And with the average household spending 30% of their income on housing, a 4.5% increase in housing costs can be significant. We'll explore this in more detail in the next section. Inflation doesn't just affect your savings and investments. It also impacts your daily expenses. With a 4.5% inflation rate, the cost of everyday items like food, housing, and transportation increases. For example, if you spend $500 a month on groceries, that's an additional $22.50 per month due to inflation. And with the average American household spending 30% of their income on housing, a 4.5% increase in housing costs can be significant. Back in 2008, during the housing crisis, many households saw their housing costs increase by as much as 10%, which led to a significant decrease in consumer spending. But some argue that wage growth can offset the effects of inflation. However, with the current wage growth rate at 3.5%, it's not keeping pace with inflation. So, what can you do to reduce the impact of inflation on your daily expenses? One strategy is to create a budget and prioritize your spending. For instance, you can cut back on discretionary spending, like dining out or subscription services, and allocate that money towards essential expenses. Additionally, you can consider investing in a budgeting app or consulting a financial advisor to get personalized advice. But it's also important to consider the potential downsides of budgeting, such as feeling restricted or missing out on experiences. And with the rise of online shopping, it's easier than ever to compare prices and find deals. Next, we'll explore how inflation affects the housing market. But what about the impact on your mortgage? Could inflation actually make your mortgage payments more expensive? We'll explore the surprising ways inflation affects the housing market, including how it can impact your ability to buy or sell a home, and what you can do to protect yourself from these changes. For instance, a $200,000 mortgage with a 3.5% interest rate could see its monthly payment increase by $100 due to inflation, which may not seem like a lot, but adds up over the life of the loan. We'll dive into the specifics of how inflation affects the housing market in the next section, and provide you with actionable steps to take to protect your finances. The housing market is another area where inflation has a significant impact. With a 4.5% inflation rate, the cost of housing increases, making it more expensive to buy or rent a home. For example, if you're looking to buy a $300,000 home, a 4.5% increase in housing costs would add $13,500 to the purchase price. And with mortgage rates increasing, the cost of borrowing also goes up. But some argue that the housing market is less affected by inflation than other areas of the economy. However, with the current housing market trends, it's essential to consider the potential impact of inflation on your mortgage payments. So, what can you do to protect yourself from the effects of inflation on the housing market? One strategy is to consider refinancing your mortgage to a fixed-rate loan, which can provide stability and predictability in your monthly payments. For instance, if you have a $200,000 mortgage with a 3.5% interest rate, refinancing to a 3.25% interest rate could save you $50 per month. But it's also important to consider the potential downsides of refinancing, such as fees and closing costs. And with the rise of online mortgage platforms, it's easier than ever to compare rates and find the best deal. Historically, during periods of high inflation, the housing market has been less affected, but this time may be different. Next, we'll explore a contrarian view on inflation. While many experts agree that inflation is a significant concern, some argue that it's not as bad as it seems. One contrarian view is that inflation can actually be beneficial for certain groups, such as debtors. For example, if you have a mortgage with a fixed interest rate, inflation can reduce the value of your debt over time. But this view is not without its criticisms. Some argue that the benefits of inflation for debtors are outweighed by the negative effects on savers and investors. So, what can you do to take advantage of the potential benefits of inflation? One strategy is to consider taking on debt, such as a mortgage or a car loan, and using the borrowed money to invest in assets that historically perform well during periods of high inflation. For instance, if you take out a $20,000 car loan with a 5% interest rate, you could use that money to invest in a real estate investment trust, REIT, which has historically provided returns of 8 to 10% per year. But it's also important to consider the potential risks of taking on debt, such as the risk of default or the potential for interest rates to increase. And with the rise of alternative lending platforms, it's easier than ever to access credit and invest in alternative assets. Back in the 1970s, during a period of high inflation, many investors saw significant returns on their investments, but this time may be different. Next, we'll summarize the key takeaways from this video. In conclusion, the Fed's inflation fight could cost you $4,200 a year. To protect your finances, consider investing in assets that historically perform well during periods of high inflation, creating a budget, and prioritizing your spending. Take action now by reviewing your budget and making adjustments to reduce the impact of inflation on your daily expenses. For example, you can start by reducing your discretionary spending by 10% and allocating that money towards essential expenses. Additionally, you can consider consulting a financial advisor to get personalized advice on how to protect your finances from inflation. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about inflation, hit subscribe. I break down one of these every week, providing you with the insights you need to make informed decisions about your finances. And, as a special offer, download our free guide to inflation-proofing your finances by clicking the link in the description below.